Well, good afternoon, everyone. Art Alvarez at Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. You know how it's the case sometimes that expectations, you have a certain expectation and it proves not to be the case. In terms of our weather out here in Palm Springs and the greater Coachella Valley area, we're in October. So we're thinking, okay, time to get a more comfortable temperature level. We're going into the fall. And of course, what happens? We have a little bit of a heat wave. In fact, there was predictions we'd be in the one teens over the weekend. It looks like that's come back off a little bit, although we were in the one teens midweek. And I think overall in Southern California, it's been a little warmer than normal, although I think we call that an Indian summer. Similarly, in terms of the bond market and the mortgage market, after the Fed meeting a couple of weeks ago, the expectation was we're going to see much lower mortgage rates. And guess what? That hasn't happened. They've actually gone up a little bit. So let's go ahead and get into the details on that. First thing we like to do is bring up our rate grid from our website. Just pulling that up now, you can see the rates there. They're still pretty good. So it's not like doom and gloom necessarily, but we're off our lows. We actually probably hit the low point in terms of mortgage rates on September 17th, the day before the Fed 2 days of work, the day before the Fed's 2 days worth of meetings. And since then, mortgage rates are up about 0.25%. But still, the good news, glass is half full side is we're still under 6% for most programs and still in the low fives for FHA, VA, and for, of course, conventional 15-year fixed. Jumbos are just right there at about 6%. So what's going on with the market, this week, and certainly since the Fed meetings? Well, there you can see the 10-year bond yield. Again, I harp on this all the time. It's your best benchmark to track mortgage rates. We're actually up to 3.85. Remember, on September 17th, that bond yield was 3.6. So again, we're about 0.25% higher in bond yields beyond the expectation, certainly of most any consumer. Anyone I've been talking to about a refinance or a purchase mortgage are a little bit disappointed to see this outcome after the Fed meetings. And again, that's because I think the media, unfortunately, doesn't do a very good job in terms of explaining how all this works. It's a little bit complicated, but the notion that the Fed directly controls mortgage rates, as you know, I've said many times, is not true, and you should not focus on the Fed to track mortgage rates. So in terms of that, let's look at a few things that are going on this week in terms of economic data points and so forth that is causing the reaction by the markets. And of course, I put at the top there, mortgage rates down after the Fed 0.5% cut. Not so fast, didn't happen. Earlier this week, and I think this is part of what's contributing to this little bit of a trend upward in yields. Chairman Powell did speak. He gave a speech. And in doing so, he said a couple things. One is he said the economy is actually in pretty solid shape. There's a belief or this growing belief that we're getting into a soft economy, maybe into a recession. I think that was what was driving bond yields down before the Fed meeting. And Powell's comments were more along the lines of, no, we're in actually pretty good shape in terms of the economy overall. And he further went on to say, and I think this is where he tempered some enthusiasm in the market, that more rate cuts are coming, but they're going to be at what he called a measured pace. So that kind of took the air out of the balloon, the excitement about we're going to have more rate cuts the rest of the year. Again, the expectation is November and December. And before Powell's speech, there was actually a pretty strong belief that we could see another 0.5% cut in November in the Fed funds rate. Again, doesn't directly correlate to mortgages. That seems to be at this point off the table after Powell's comments. Economy is in solid shape. They're going to take a slow approach in terms of more rate cuts. So that, I think, is part of the reason why you're seeing that 10-year bond yield go up and therefore mortgage rates trending upward as well. The other thing, too, is the JOLTS report, job opening labor turnover. It actually increased a little bit. 8 million was 7.7 million previously. That, again, is job openings. That's an indication that the labor market's hanging in there pretty well. That if there is more job openings, that certainly doesn't portend a recession coming. So again, that was another factor that I think has caused these bond yields and mortgage rates to trend a little bit higher. But yet we have cross currents. ISM Manufacturing, Institute of Supply Management, their manufacturing index was 47. Again, sixth straight month below 50. That means a contracting manufacturing sector. So of course that is sort of at countercurrents to the JOLTS report showing the labor market getting a little bit better. And then both today and tomorrow, we have a few data points coming out. ISM services, that came out today. Again, Institute of Supply Management Services Index, that came out pretty strong, 54. Again, anything over 50 is a growing sector. So what we have here is manufacturing, not so good. The service sector going along very well. So again, cross signals there. And I think this ISM services number today is part of why we've seen this bond yield jump up a little bit, because yesterday it was hovering around 380. Now it's 385. So a strong services sector in the economy isn't helpful in terms of keeping bond yields and therefore mortgage rates down. Tomorrow we've got those important employment numbers, non-farm payrolls. That's again how many new jobs were created, and then the unemployment rate. So we'll see what happens with those job numbers. If they reflect any sort of weakening in the job market, that could help us kind of get this market settled down, and maybe the bond yield will start falling back down. Part of what Powell made clear in his speech is they have a dual focus. They're going to focus on stable prices and maximum employment. They're trying to do both things at once, and that's why they're kind of balancing that goal or those dual goals, and that's why I think they're going to take a more measured pace. So that's where we're at in terms of mortgage rates and bond yields. Again, it's a little disappointing, I'm sure, but again, the good news is we're still under 6 for most programs. So again, keep that in mind. If you're a home buyer or if you're considering a refinance, now is still a very good time to take advantage of either type of transaction. And with that, I'm going to bring Jeff back so we can have a discussion about a couple of interesting subjects this week. Hi, Jeff.
Yeah. Hey, how you doing, Art? It's interesting, and I'm a novice when it comes to this whole process of what causes what to go up and down. Although I'm much more in tune to it now, being on this side of the camera and listening to all your wisdom. But typically, I see if the stock market goes down, I kind of see the bonds kind of recede. In other words, the potential interest rates go down. But today I see the stock market is down and the bonds are up. Is there a correlation with that?
Well, yeah, that's an interesting observation, and there's something to that. There's a concept in the markets, certainly in the mortgage industry, and as we watch the financial markets and the stock market and the bond market and so forth. Of course, the stock market doesn't have really any direct correlation to mortgages at all. But what can happen is if you see a stock market that is selling off substantially, and of course, there's still predictions that we're going to have a pretty good correction coming up at some point. Well, when something like that happens, barring any other economic news or data points, what you can see is what we will call a flight to safety. We'll see money coming out of stocks and going into bonds. You put more money into bonds as a safe haven, that's going to drive bond yields down. So at times we will see that flow of funds phenomenon if the stock market's selling off and money's moving out of stocks into that safe haven of bonds. But that doesn't always occur like today. Today, I think what's going on is the ISM Services Index came out pretty strong, which normally you would think, okay, that should be good news for stocks, right? The economy is doing well. But you've got to consider at any given time, there's a certain mentality in the markets. And remember, we don't have it on the slide now, but very often in our initial slide, we'd say on financial markets, they respond with reptilian-like minds to stimuli. So that changes from time to time. And right now, today, I think what's going on is that services index came in pretty strong. While that's otherwise good news, the markets are saying, well, wait a minute. If the economy is actually doing that well, then that's going to diminish the chances the Fed's going to lower the Fed funds rate further and frequently. So I think that's really what's going on. It's like good news, bad news. Okay, it's great news. Economy's doing okay, at least on the services side. Again, manufacturing, not so much. But good news on the economy, as we know, can be bad news for bonds and mortgage rates. And so in this case, that's what you're seeing is the stock market's going, oh, we don't like it this time because it's hurting our chances of getting rates even lower.
It's wild because it's like I feel like I'm in the stands watching a football game, but I'm rooting against my team because I've bet on them losing and I'm covering the spread.
Well, that's why for years I've told prospective mortgage borrowers that unfortunately it generally is true that if you're looking to get better rates, you want to almost root for bad economic news. And it's unfortunate to say that because you don't want people to lose their jobs and be out of work and all that. But there is a pattern there. And of course, there can be other things. We haven't talked much about this, but international events can be a big factor. There's a lot of turmoil in the world right now. And if something really, really significant and bad happens, we could see a real flight to safety. The stock market could really, drop considerably, and money could go into bonds just because at an international level things are getting way, out of whack and way too much turmoil. And so even that could be a factor at some point. So we have to keep that in mind as well. So.
Well, on that same topic, I just read that was it last night at Tuesday night, the longshoremen on the East and the Gulf Coast have gone on strike, and they were saying, this could affect our economy by $5 billion a day. Do things like that factor into what we're talking about here today?
Well, sure, it definitely could. Now, again, it's going to take some time to really see how that squirts out, because, that could be very, bad for the economy in terms of, diminishing, activity, which again, a more depressed economy generally is good for mortgage rates and for bond yields. Now, in this case, it's going to be more of a mixed bag, because to the extent that the economic data points come out after this strike has started, things like the labor numbers, it's going to take a little bit more analysis to look at those labor numbers. Let's say the unemployment rate's up, or manufacturing and services activities starts to drop. Well, you've got to peel the onion on that and take into account, well, to what extent is this strike, which is going to significantly impact the economy nationwide, what influence does that have? And of course, if it's significant, it could be looked at as something that is relatively temporary, and therefore the markets may not react as poorly as you otherwise would think. So it can get kind of complicated in terms of the analysis. So we'll see how that goes. I'm a little surprised that there's not a little bit more focus at a federal level to try to get this strike situation resolved sooner than later. They seem to be taking more of a hands-off approach, and I'm kind of surprised by that.
That is surprising. Well, the topic of today that I want to ask you about, because you've told us about in past shows about, hey, when's the best day to close your loan? But today I have something I want to share that I think is going to be kind of interesting. Is, okay, that's a great theory, but is there a best day to lock in that rate? And is Wednesday the best day? And I'm like, is that fact or fiction?
Well, it's interesting. By the reason that you're asking the question, I suspect that you have a sense or a gut, feel that maybe Wednesday is the best day to lock. Is that what you're thinking?
Well, as I create these your rate grids from the 10-year, I noticed an interesting trend that every Wednesday, it seems like for the last several weeks, the lowest rate is somewhere right around Wednesday. I'm just curious, why is that, Art?
Well, yeah, and since, you had prepared me for this discussion, I did a little bit of research on that. And I think what I came to conclude is it's inconclusive, because I went back actually several months. I went back for the past year, and I literally was looking at the bond chart over that period of time and scrolling through it and looking at the date. I had a calendar out and looking at the days, which date is a Wednesday. And what I found really actually is kind of a mixed bag.
Okay.
There were some Wednesdays when it was up and then it dropped later in the week, and some Wednesdays it was down versus earlier in the week. And really what occurred to me is when you go back and look at economic data points that are released every week. And by the way, for any viewers out there, you can pull this up yourself. U.S. Economic Calendar. There's a website called Market Watch where you can pull up a calendar of U.S. economic data points that are released every single week. And so really that's what drives the correlation between mortgage rates and bond yields from week to week. Now, a couple of things I will point out in terms of that, phenomenon that you were observing, at least more recently, is certain economic data points do tend to be released during the middle of the week. For example, just 2 weeks ago, the Fed had their meetings on Tuesday and Wednesday, and of course the meeting concluded midday Wednesday, and then they made their announcement. So, and the Fed always meets Tuesday and Wednesday, so that is always going to be a factor. But does that mean every time they meet, bond yields and mortgage rates dip? No. Sometimes it's the other way, depending on what the Fed says or what they announce. This 2 weeks ago, what happened was you saw a decrease in the bond yield end of day Tuesday. You can say, oh, that's almost midweek. But then what happened? Meetings concluded on Wednesday. They make their announcement, 0.5% reduction. Everybody's cheering. But oh, wait a minute, that 10-year bond yield's going up. That's people were like confused by that. At least consumers were. I was not surprised, frankly. I've been telling some people, hey, you're better off locked before the announcement, not after. Well, I don't always have the answer there, but after years and years and decades of watching this, I've noticed some patterns. And so that I think that has more to do with the dips from week to week and during the week. It's all about which economic data points are being released that day, and a lot of them do tend to be released midweek. First of the week and Fridays, not so much, except for a couple of things. The Fed's favorite inflation target, PCE, Personal Consumption Expenditures Index, is generally released on a Friday. That can move the markets. And the other thing, as I pointed out earlier, is going to happen tomorrow is the jobs report. Tomorrow we're going to hear how many more jobs were added to the economy and what the unemployment rate is. That's generally released on a Friday. So that can have an effect end of the week rather than on a Wednesday. So I think really ultimately, I think the lesson here is, to the extent you want to become, a financial nerd and start paying attention to the 10-year bond yield all the time, like I do, because I have to for what I do for a living, is maybe look at that U.S. economic calendar, and then look at the 10-year bond and try to draw some parallels or connections between the data and how the bond market reacts. And the two things to focus on, if you want to just generally track mortgage rates and the bond market, or actually track the bond market so you know what's going on with mortgage rates, the two primary data points I would say you want to pay attention to are the inflation numbers, CPI, PPI, PCE, and the labor numbers. How many new jobs, the jobs report, initial claims for unemployment, and the unemployment rate. Because again, as I said earlier, the Fed's focus is dual. It's inflation and jobs. And so if you want to draw sort of a connection and follow what's going on with yields, pay attention to those two types of data points. And I think that's going to prepare you for what to expect. So if you're, if you're an agent, I would argue, take a look at the 10-year bond yield every day. I mean, you're out there selling homes. People are asking you, your borrowers, your sellers, and your buyers are saying, what are rates doing? Well, if you just look at the 10-year bond yield every day, you're going to get a pretty good idea where they're going. And if you're considering a refi or you're considering getting into the purchase market, same thing. Take a look at that 10-year bond yield. As it moves, you can pretty much bet the mortgage rates are moving in the same direction and by the same amount.
The other thing I wanted to ask you is something that's kind of resurfaced itself, and this is when someone, let's say for instance, I put a loan in with you, you submit it, and then immediately my phone starts blowing up and emails from people that are doing exactly what you are, but I've already locked in with you. I've already started the process with you. What is that all about? How is that working out?
Well, actually, that's an interesting question. In fact, I think we have that as our closing question for next week. So maybe I don't want to give away too much of the story there, but let me give the viewers a hint. And it's an interesting label, actually. They're called trigger leads. And it's a practice, believe it or not, that's been around since the 70s. Or at least let me restate that. the pathway to be able to have this phenomenon occur goes back to the Fair Credit Reporting Act, which was in the 1970s. And so it is something that does happen, but there is efforts underway to disallow that from happening. So
All right, good. I don't want to steal any thunder there. It was just something I'm aware of. I spoke to someone that we both know, and they mentioned that, and I said, I'll ask Art when we do our live show on Thursday. But
yeah,
the other piece I want to ask you about is there's a question that says, should you pay points for a lower rate when refinancing your mortgage?
yeah, interesting question, and I'll share something with you and the viewers. It's been my belief, for most of my career, certainly as we've gotten into the more recent years and decades, where mortgage rates generally were priced out at 0 points. And most of the transactions we do, the borrower doesn't pay any points for the rate that they're getting. And the basic concept involved, paying points when you're the borrower, paying points yourself is a little bit tricky because what's happening is, of course, it's increasing your closing costs, and in return, the improvement in rate and payment that you're going to get, in my opinion, is not necessarily all that significant. So what happens
Mhm.
is you get into a situation where you have to evaluate the more you pay in points for that lower rate and payment, how much time is it going to take to recapture that point cost from the lower payment. So that's always been my sort of my position and my counsel to my borrowers over the years. Well, we mentioned a couple of weeks ago in our program that one of the lenders we deliver loans to, in fact, the largest wholesale lender in the country, United Wholesale Mortgage, they go by UWM. They have a campaign going on through the end of this month. They call it Refi 75. And, that doesn't mean you're going to get 75 or 0.75 off your rate. But what they are offering is 0.75 in points off the price of the mortgage, which helps you get a better rate, typically about an eighth or quarter better rate. Well, since they announced this initiative, the CEO of UWM, a man named Matt Ishbia, he does these podcasts and these videos on their own website, and he is promoting big time the concept of, if you're pursuing this Refi 75, um, that you should not just look for a 0 point rate, that you should pay points to get your rate as low as possible. And when I
Hmm.
first watched his video, his podcast, I was like, that doesn't sound like good advice to me. And I'm kind of surprised this CEO of this major publicly traded mortgage company would be, pushing this so strongly. But he really, really is pushing it. Now, his argument is uh, you can finance it into your loan amount, and it gets you a lower rate and payment so that you're going to be in a better position for a longer term before you might have to refi again if rates continue to fall. And I can kind of agree with that part. That's kind of goes back to our previous episode where I said, you're better off taking a 0 point rate than a no cost rate, because with the no cost rate, you're taking a higher than market rate to finance the cost through the rate. So I
Yeah.
argue that's a bad idea. You should take the 0 point rate and finance it into your loan amount. Well, Matt Ishbia is taking the argument a step further and saying, no, don't do a 0 point rate. Take a 1 point rate or a 1.5 point rate or a 2 point rate
Wow.
and finance that cost into your loan amount along with the other costs you're financing into your loan amount. You're going to get a much lower rate. You're going to get a much better payment. And so you won't have to refi as often if rates continue to trend down. So what I did is, because I thought, well, maybe I'm, been stuck in my ways and I should start talking about that with some potential refi customers. But let me give you a quick example. Let's assume you're looking to refi and your home value is 800,000 and you need a $600,000 loan. Well, right now at about 5 7/8, your monthly payment, 5 7/8 at 0 points, your monthly payment is 35.33, principal and interest. Now, let's say you decide you want to pay some points to get that rate down. Well, you could take your rate down to 5.5. Now, 5.5 will cost you about 3/4 of a point. Now, by the way, A point, folks, is 1% of your loan amount. 1 point is 1%. So 0.75 points of a $600,000 loan is about $4,400 in additional closing costs. And that'll get you 5.5, which is a 3406 principal and interest, a difference of $127. So then the next thing you would do is take that 4423 in point cost, divide it by the monthly savings of $127, and that tells you how many months it's going to take to recoup that $4,400 in point cost to get that lower payment. You know how long it takes? 35 months. Now, if you're going to be in the home that long, you're pretty certain you're going to keep the loan that long, and you have a belief that rates aren't going to go that much lower between when you do this refi and 35 months from now, you can make an argument, yeah, that might be a good approach. But what if you don't keep the loan for 35 months? What if rates drop another 1%, 12 months from now? Well, you probably still refi and you just figure, oh, well, sunk costs, but you're eating up some of your equity by paying those extra point costs when you did this refi now. What if something happened? You suddenly got to, sell your house and move. I mean, so you have to think in terms of what ifs and what's the probabilities you're going to keep the loan long enough to recoup the cost. In this case, 35 months. Then I took it one step further. What if you bought the rate down to 5.25? Okay, at 5.25, it's 3313 on the principal and interest. That's a savings over the 0 point rate of $220 a month. Pretty good savings. But the points, it's like $12,817. That's basically over 2 points. It's about 2 1/8 points. That's a hefty amount of points to roll into your loan amount. So hopefully you have enough equity that you can roll it into your loan amount. Let's assume you do. Well, $220 a month savings divided into the $12,817 for 2 1/8 points, it will take you 58 months to recoup the point cost from buying down the rate to 5.25 from 5 7/8. That's where it starts to get really fuzzy. Are you going to keep that loan for 5 years? Are you certain you're not going to have to sell and move? Are you certain that there's not going to be another refi opportunity? You've got to realize that those kind of possibilities could undermine this strategy. And then, of course, with the benefit of hindsight, you might go back and say, well, why did I pay that extra 2 1/8 points to save $220 a month when I could have gotten 5 7/8, which is still a lot better than my current rate, and not pay any points at all? So it's an interesting set of numbers here, and I'm still a little bit sort of baffled why this CEO of UWM just thinks this is the greatest strategy in the world. I'm still having trouble with it, but I want people to know about it because they're a big company. They serve only the wholesale community, so they serve brokers like us. They don't deal directly with retail customers, and so there may be a lot of originators like us out there pushing this kind of approach. And I just think people need to understand these numbers and realize, yes, maybe, but again, you got to be pretty certain about you're going to stay in the home and you're going to keep this loan after you get it long enough to actually fully benefit from this strategy. Because if you don't keep the loan long enough, it's going to end up being sunk costs that you could have avoided.
Do you think, Art, that the last 3 to 4 years of the rates that let's say somebody like myself locked in a lower rate, and we're thinking, that has kind of set a precedent that we're not moving as often, right? We're saying, hey, we're not going to give up our rate. So maybe there's this false sense of we're staying in our homes longer. Is there any evidence to prove that? Or are we still moving every 5 to 7 years?
Well, yeah, I mean, I've talked about that before. Certainly, particularly in the state of California, most mortgages really do only last about 5, 7, maybe 10 years at most. I think we have been in a different environment for the last couple of years, unusual compared to historical, numbers and context, because, we had a 100-year pandemic. The federal government pumped massive amounts of money into the economy, drove real interest rates practically to zero, certainly in the 2s and 3s. And so we have an unusual environment now compared to past cycles where so many people are locked into their homes because they have such low rates. They don't want to sell and move because they're afraid of what they're going to have to deal with in terms of higher rates. That's unusual. We've never seen that phenomenon to this degree that I can remember in 40 plus years. So as a consequence, maybe there's something, maybe that's entering into his thinking about, yeah, well, you should refi and pay points and get the rate really low, and you're going to stay in your home another X amount of years.
Hmm.
Eventually things are going to change on that. If rates come down any more, I would say if we can get another 1% improvement, if we can get under 5, I think things are really going to start to happen. I think we're going to start to see people looking to move, put their house on the market. And of course, again, folks, for those of you who think that that's going to, bring home prices down, I don't think it will. It's going to drive them up. But if we can get another 1% in rates and get under 5 into the 4s, then I think people are going to start, moving and shaking, and you're going to see more homes on the market. People are going to start moving more often. And then again, this strategy, if you did this before that occurs, if it occurs, then paying those extra points may have been possibly wasted money.
Well, Art, thank you so much. You're always a wealth of knowledge. And, for those of you out there that maybe you're watching this live or you're watching it recorded, I want to put Art's information on the screen there. The best thing to do is to call Art and give him your specific scenario, and he can help walk you through this and to find out if this, by using points to buy down your rate is the best thing, or based on your scenario, no, you're better off not doing that and just taking the rates where they are now, which quite frankly, they are in pretty good shape compared to a year ago or even 8 months ago when we were talking about this. The rates have come down. I think you talked about that number of, hey, if we can get under 6, we're going to see some movement. And I think we have started seeing some movement.
Yeah, we actually have. I mean, it's interesting though, the media makes it sound like we've got a massive refi boom going on. Not quite true. There is more activity, but I've talked to some of my wholesale lenders, and they're saying, well, yeah, it's a little better, but it's not a floodgate coming. I mean, it's just not. And I've talked to some escrow officers, same thing. I mean, I talked to one yesterday, and she was kind of moaning and groaning about the fact that she actually said, I wish there were more refis going on. What's going on? Why is that not happening? And of course, I reminded her, I said, well, rates are actually up 0.25% since 2 weeks ago. So maybe that has something to do with it. And again, a weird phenomenon. I'm seeing more homeowners playing the market, and they're like, there's money on the table that they can save in a monthly payment, but they are waiting for even lower rates because they want to save even more before they take the next step and submit that application. Some of those, I think, are wishing they hadn't done that. So I'm hoping people will get off the fence and move forward. If you're in the high 6s, you're in the 7s, you should refi. You should do it right now. If you've been on the fence about buying a home, we're under 6, get out there. There's opportunities. There is more inventory. There's more negotiating going on with prices. So it's a good opportunity.
Well, Art, as always, thank you very much. Your information is on the screen. Call Art at 760-969-5023 or his cell number at 714-612-9035. And as I've seen it happen, is he was begging people to take action before the rate cut from the feds. And, it's like putting everything on red and all of a sudden it fell on black. Things change. So don't do that. Give Art a call today. Art, thank you so much. I'll turn it back over to you.
Jeff. Thank you. Okay, folks, now we're going to go to our next segment, the closing question from last week, which actually was 2 weeks ago, because any of you who watched the show last week, I was actually in Long Beach for the California Association of Realtors Reimagine conference. So we broadcast from Long Beach and had a different subject at the time. So this is actually from 2 weeks ago. Here it is. And this actually is in reference to a transaction I'm actually handling right now. We're trying to purchase a home and we'll have about a 30% down payment. But our credit score is in the mid 500s due to past credit issues that have been resolved. We've only been offered a hard money loan and the terms are terrible. Why can't we get better terms given our large down payment? Excellent question. We do run into this from time to time. So let me tell you what's possible. And this is how I approached a customer who came to me with generally these kinds of parameters. First of all, as to hard money, it's actually called these days private money, as I put there, AKA hard money. Hard money is sort of considered a negative term now. So all those lenders in that space prefer to be called private money lenders, not hard money lenders, just so you know that. But it's not your only option, which is what this borrower, I think, initially encountered. They were offered something that was private money, aka hard money, and the terms really were awful, very high rate, high fees, etc. Well, I want you to know that if you're in this situation and you have some down payment money, FHA is your path to a reasonable rate. So let me explain. With FHA, now the standard FHA program allows for a 3.5% down payment, but for that you have to have a score of 580 or higher. You can get a 3.5% down payment and get financing, assuming you otherwise qualify on income and so forth. But what FHA does allow is a credit score down to 500. So 500 to 579, you can potentially get an FHA loan as long as you have at least a 10% down payment. Now, a couple of things about this, though, you have to keep in mind. One is the best way for this to work is when you submit an application to an originator like us. One of the first things we're going to do is we're going to try to submit your scenario, including your credit history, through the Fannie Mae software underwriting system called DU, Desktop Underwriter. It's used nationally by most lenders. It's basically the product used to determine individual or specific approval recommendation. So the first thing we're going to do is run your scenario through DU to see if we can get an approve eligible finding. If we're able to, you're in good shape. Even with the credit derogatory credit history that you have, you're going to have to explain that, but otherwise you're going to be good to go with your credit score. And I have one right now where the credit score is 561, and we got a DU approve eligible. So we're on our way to getting this purchase loan closed for a customer in a similar situation as this question. Now, what are the watch out fors? Manual underwriting. Now, some lenders will only do under 580 as a manual underwrite. That's actually not a good thing because, number one, the maximum debt ratios that are allowed are going to be much lower, like, in the 20s, 28, 36 kind of a range, or actually 28, 41. So that can be a problem for any borrowers who are, have enough income to qualify for a standard FHA loan, but they're above the manual underwriting max debt ratio guidelines. And then the other thing is you're going to be in trouble in terms of manual underwrite if your credit report shows that you have filed any disputes on the derogatory credit. So if you're in that credit score range, the first thing I would tell you, if you're trying to position yourself to get a mortgage, don't record or file any disputes on any of the accounts. If you do that and you're trying to get this FHA loan, it's going to trigger automatically going to a manual underwrite. And then what you're going to deal with is what we call credit overlays. In other words, the lender is going to allow only a limited number of late payments for 30, 60, or 90 days within the last 12 months. And chances are, if you're in this credit score range, you may have more than the allowable number of lates during the last 12 months, which would be an automatic decline. So again, this can be a very good option for someone who's under 580. You've got some down payment money, you had some derogatory credit, you've got that cleaned up, the history's still there. You don't want any credit disputes recorded or filed on any of the accounts. And if you're otherwise good on income and so forth, we run you through DU, we get an approve eligible, you're going to be able to get a good loan package at a reasonable rate. In fact, the one I'm working on now with a 561 credit score, we're going to get them an FHA loan at 6 5/8, certainly higher than a standard FHA with a good credit score, but compared to hard money or quote unquote private money, a lot better. Instead of 9.99 or 10.99, 6 5/8 is pretty darn good. So good question. Hopefully that helps any of you who are in a lower credit score level. You've got some down payment money, you want to buy a house, give me a call. I'll be happy to go over the questions with you or the parameters with you. And with that, we'll go to our closing question for next week. Here it is. Jeff kind of touched on it earlier, but I'll give you a lot more information on this next week. When we applied for a purchase mortgage last year, we were bombarded with phone calls and text messages from lenders. Why did this happen and how can it be prevented? We actually covered this many months ago, but it's kind of getting to the forefront in the news. So I want to go over this again, and I'll give you the answer to this question next week, and it'll be on the house. Well, that's it, everyone. Thank you for watching and listening to this week's Mortgage Minute. My name is Art Alvarez at Mortgage Works, where we have the answers and they're on the house. Have a good weekend and stay stay tuned for next week's program. Thank you. So long. Take care.